Welcome to the SeizeYourBusiness.com podcast. My name is Kevin O'Flaherty from O'Flaherty Law. My partner, Jim Wozak from Success Enhancement, couldn't beat it here today, but I'm joined by Amanda Hark from Heartland Bank. And tell me again, 504 loans? Is that
SBA 504 loans,
okay,
yes.
SBA 504 loans. Amanda was telling me about that yesterday, and it seems like a great deal and a great way to refinance your existing commercial loan. So, Amanda, I'm going to let you take it away. Let's start by telling me a little bit about yourself and what you do.
Sounds good. Well, I currently work for Heartland Bank and Trust. I've been in banking since 1998. I started out as a teller, worked my way up, was in credit for many, many years. And I really do think that is what creates a good banker, is having a firm knowledge of financial statements and accounting and all of that stuff. So after I did that, I decided, you know what? I know a lot of people. I like numbers, but I really, really enjoy people, small businesses. So it's time to be a loan officer.
And how long have you been a loan officer for now?
Since 2006.
Okay.
Yeah, it's been since 2006, 2007 maybe, right at the beginning of 2007.
So what makes your bank great? Why Heartland Bank?
Heartland Bank is a family-owned bank that's based out of Bloomington. We made it through all of the bad stuff there in 2007, 8, 9, 10. And, we came out booming. We've been buying other banks, especially in the area here. We just assumed American Midwest Bank. And we've got now 68 locations that are kind of around between Bloomington and Chicago. The best part about us, though, is, we're about $2.8 billion in assets. So that means that we can legally lend one company up to about $30 million. But we really, not that we don't want that large middle market stuff, we like to help the small business owner. And that's kind of where we ingrain ourselves. We know all the products that are based around small business owners.
Well, that's great, because not every bank is focused on the small business owner. Some are, I've met with bankers that say, unless it's a certain $1 million revenue business, 10 million, they're not terribly interested in dealing with them. So it's great.
Last year, I did a loan that was $12 million, and I also did a loan that was $20,000. So you can kind of see we are all across the board. The best part about us, though, is that you don't deal with the loan committees. We're structured in a way to where I've got a phone, I can pick it up, I can call our president or the head of our credit department and just say, hey, look, this is what I'm looking at today. What do you think about this? And they'll tell me proceed or don't proceed. And if I don't
probably
proceed,
expedites the process a lot.
Yeah, it does. So you're not waiting for loan committee after loan committee after loan committee like a lot of the banks that are out there. Mm-hmm. The best part about that, though, is that say I can't do it today. I'm not just going to say, hey, no, we're not doing it. It's going to be, okay, I can't do it today, but let me help you find a bank that can, or let me help you get your financial situation in order to where you will be able to do this within 6 months or a year or 2 years.
That's great.
Let's get you to that place. And that, once again, goes back to the credit background, that I understand balance sheets and cash flows and all of that.
So tell me about SBA 504 loans. What are they? How do they work?
I personally love these. Right now, just as an example, we have a customer that has always rented. She spends around $3,500 a month in rent. And she's a small business, under, $1 million a year in revenue. And that's a lot of money to be spending on rent. Mm-hmm. The best part about a 504 is that if you are not special use meaning a gas station or a car wash or something like that, you only have to put 10% down. Okay. So it's called the 50-40-10. You put in 10% equity, the bank puts in 50% equity, and then the SBA does 40%.
Okay.
The bank is in first position on the mortgage, and we love it because we've got a 50% loan to value. Mm-hmm. The SBA, you will love it because they give you a 20-year fixed rate. Okay. You don't get that from a bank. From a bank, you'll get a 5-year fixed rate.
So banks is typically an adjustable rate loan.
No, from a bank it is a fixed rate loan,
okay,
but it's only for 5 years. It's amortized out over 20 years, but you only get a 5-year fixed rate. And you also get a 5-year term, where with an SBA 504, the bank is required to give you a 10-year term. Now, the rate can change after 5 years, but you're required to have a 10-year term, meaning the bank must take that loan again after the 5-year rate is up.
Okay, so I apologize. I'm not as up to speed on commercial lending as you are, obviously. So when you say it's not an adjustable rate, but it's this 5-year fixed rate, what happens at the end of the 5 years in a traditional loan?
In a traditional loan, we re-underwrite it completely, meaning that you get a whole new rate. You get, we look at it again. We could actually turn around and say to you, we're not really liking this. You need to get out.
And so then what would happen at that point? The entire balance of the loan would be
up for maturity. Okay. Where with this, the balance of the loan is not up for maturity until 10 years. We still look at your financials. We still talk to you about what you could do better, what you're doing well already, but you have a 5-year or a 10-year commitment from the bank.
Okay.
And that's really great. Now, the SBA portion is even better. That's 40% of your loan. You have fixed for 20 years. Right now, that interest rate is 3.88%.
Oh, wow.
For 20 years, you do not need to touch that.
That's a great deal.
It is a great deal.
So, you just kind of blew my mind with the way that a traditional loan works. So, are these loans that are secured by the property we're talking about?
They are. They're secured by the property, and they're at 90% loan to value. Okay.
And so, if the 5 or 10 years come up and the bank says, we're not going to continue with this loan, that business, and I just want to make sure I'm clear on this, that business owner then has to just pay the entire balance or forfeit the property and have
There's many different ways to do it. I'm not a workout lender.
Okay.
I have done that in the past, and yes, the bank can foreclose. The bank can do many, many different things. If you don't make your payment, they can always find another bank to go to as well.
Okay.
But normally a bank will be out there for 5 years at a time before they completely reevaluate and renew your first mortgage.
Okay. And what are the situations when banks in a traditional loan would actually decide not to continue? Is it like the business is failing or something like that, or is that a rare thing, or is that a common thing for?
You know what? It depends on the state of the economy. Back when I was in workout lending in 2008, 2009, it wasn't a very rare thing. Today, we don't see as much of it. As a bank, our portfolio is pretty clean. Problem loan wise, we don't have any really on our books at this point. So it really depends on the state of the economy.
And so at the very least, after that 5 years in a traditional loan, your rate might be jacked way up, so that it's hard to plan for how much you're going to be allotting to your.
Well, and remember, rates fluctuate. Mm-hmm. So today, rates are pretty good. You can get a 5-year fixed loan, 25-year amortization at 4.5%, something around there. Where in 5 years from now, you've got interest rate risk. Sure. You don't know exactly where it's going to be. Looking back, even for floating rates, if you look at prime, in 2004, we were at 4%. By 2008, we were up to 8.5%, and then it plummeted. Mm-hmm. So during that time, businesses really saw an increase in their interest expense.
So with this SBA 504 loan, the SBA portion of the loan is locked in for 20 years at that rate.
Years.
And then the bank's portion of the loan, you said, is 10 years that it's locked in?
With a rate reset after 5.
Okay.
Yes. But you are guaranteed it is locked in for 10 years.
Okay. And I've heard that the SBA takes a little longer than a regular loan. Is that true? Or what?
There are SBA preferred banks. Okay. And with an SBA preferred bank, which we are, it does not necessarily take longer.
Okay.
Now, you do have to go through 2 approval processes. And once it's approved with us, we hand it over to the SBA. On an average, I have found that it takes 2 to 3 weeks.
Oh, really?
Yeah.
See, in my head, I had about 6 months on that.
Especially with a 504. We work with some great guys at the SBA. It really is about 3 weeks.
So what does it take to qualify for one of these loans? Is it I assume that you have to give a bunch of your financial information, but what is the type of person that would qualify, and the line between that person and the type of person that wouldn't qualify for one of these loans?
It's all based on cash flow. We like to see at least a 1.25 coverage. Okay. That means that on all of your debt that you have, you can cover that one full time, and you can have 0.25 left over in your bottom line to apply towards retained earnings.
Okay. And what's the process for applying for one of these loans?
The first thing that you do is you apply to the bank. The bank always has, it's basically called a personal financial statement. The SBA does require you to have 100% personal guarantee on any one of their SBA loans. Now, there are other SBA loans besides the 504 that we won't talk about, but the SBA likes you to be all in. So you fill out the personal financial statement. That allows us to pull your credit. After we pull your credit, then we make sure that, you've got an okay credit score. There's no, huge delinquencies, missed payments. After that, then we ask you for 3 years of business tax returns and 3 years of personal tax returns. We like to see interim statements as well. So now it's late in the year. I'd really like to see some financial statements from June at this point too.
Okay. So if you've got 3 years of tax returns that you're giving, let's say you had a decent year, a down year, and then maybe a pretty good year where you're cash flowing positively. Mm-hmm. Do the bank and the SBA need to see positive cash flow for 3 years running, or do they just need to see that you're in a good position now and that it's, you know what I'm asking? Is it what happens if there's been a year where your business took a hit in one of those 3 years, but you've recovered from it?
You know what? Everybody has a bad year, and it really depends on the circumstances.
Okay.
So once we know those circumstances, maybe you had a huge capital expenditure one year because something happened and you needed a new truck, you needed a new roof, you needed a bunch of other stuff. I mean, things like that happen. So if it was something like that and it actually is going forward, going to help your business, then that's one thing. If it was another thing where just you are in a sector of business that just plummeted, I mean, it could be something completely different.
So it's a really fact-specific inquiry that you're doing.
And we do. We dig deep. We talk to you. We understand your business 100% before we really get into everything. I personally am not in residential lending because that's in a little box. Mm-hmm. Commercial lending to me has a lot of gray lines. You can cross over those lines for certain things. We're still obviously monitored by the Fed and everything like that, but it's a lot more open to what we're able to do. And that's why I like the business.
You would think, and correct me if I'm wrong, but you'd think since this is secured by the collateral of the actual property, that there'd be a little bit more wiggle room than just a regular straight-up commercial line of credit, right? As far as what your business has done in the past, or is it basically the same guy?
You also have to remember that a traditional, conventional loan that you get at a bank is 80% loan-to-value or less. Mm-hmm. This is at 90% loan-to-value. So we have a little bit less wiggle room collateral-wise. If I have to go in and foreclose on a building, it's going to be a lot easier to be completely paid back if I'm at, 70 or 80% than I would if I'm at 90%.
Because the value of the building might have decreased, and there's costs that are associated with that.
There's a lot of attorney fees and everything, which you know about, that are associated with that. So it really depends. But the thing that we like to see is when a business owner that's been renting for many years can suddenly own their own building. They pay less overall because what it would cost for the mortgage, the real estate taxes, and the insurance can be less than what they're actually paying. They can save money by owning their own property, as long as they've got that 10% down.
All right. Well, thanks for sharing your wisdom with us today. Is there anything else you want to share about 504 loans?
No, I think that really covers it. And that, if there's ever any questions, I'm available, or there's a lot of really good 504 lenders that are in the area.
And if people want to reach you, how can they reach you?
You can reach me at work, and that phone number is 708-246-2200, and my extension is 3368.
And if you want to reach out to me, we offer free consultation, 630-324-6666. And please check out all of our podcasts and video blogs at seizeyourbusiness.com. If you want to check out legal podcast video blogs and articles on all sorts of different legal topics, you can go to learn-about-law.com. And Jim Wazak, my partner, is a great business coach, and he teaches improv classes, and his contact information is also at seizeyourbusiness.com. So thanks so much for listening.